Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Berkshire Hathaway stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 1 trillion market cap. They're trading at $4.79 a share and they have 2.2 billion shares outstanding. Berkshire Hathaway is the first company to hit 1 trillion that's not a tech company. Every other company that did it is a tech company. Apple, Microsoft, Nvidia, etc. But Berkshire is a holding company. At one point, about half the company was Apple. So it's kind of like a tech company, but in reality, it's not a tech company because it doesn't make any products. It just holds positions in other companies. Berkshire owns businesses in insurance, rail transportation, energy generation, manufacturing, and retail. It is a large stakeholder in many prominent US companies, such as American Express and Coca-Cola. They also own private companies. They own 100% of Geico. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have a lot of free cash flow. It peaks in 2022 at 30 billion. It's down to 21 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's pretty volatile, especially in 2022, negative 23 billion, because they have to mark to market their investments. Even if they don't sell the stock, they have to mark it down if the price of the stock went down a lot that year. And it did go down a lot. They had a paper loss of 23 billion, but you can see they still generated 22 billion of cash flow. But in the following years, they had a paper gain, 107 billion of profit. Not all of that is a paper gain, because maybe they marked up their securities 30 billion, and the investments they own profited 70 billion. That's how they got to 107 billion. Revenue is a sales for the company, and that peaks in the trailing 12 months, 450 billion. They generate more revenue than 99.99% of the companies out there. They're probably top 10 in revenue. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows, past year 4, that's 838 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $740 billion. We divide that by 2.2 billion shares. And we get a calculated stock price of $343. They're trading at $478, so they're trading at a 40% premium. It's a sell according to the model. This stock always seems to be trading at a premium, yet it goes up in price because some stocks defy valuation. If you put $10,000 into this company 10 years ago, you'd have $32,000 today at 12% annual return. I bought the stock in 2017. The same day I also bought the S&P 500. And for 5 years, this stock was trailing the S&P 500, but now the stock is beating the S&P 500. I'll show you their annual returns later compared to the S&P 500, because in 2022, this stock went up 4% and the S&P 500 went down that year. That's when this stock started performing better. To summarize, I have them trading at a 40% premium, ranking 8 out of 10. It does look a little overvalued, but you don't want to wait too long, because like I said earlier, it just keeps going up. So would I buy it short term? 7 out of 10. Would I buy it long term? Definitely 10 out of 10. If you're going to hold the stock for 5+ years, this should be one of those stocks. Great ratios, 8 out of 10. Amazing PE, it's below 10. Financial, 7 out of 10. Revenue looks great, it goes up a lot. Free cash flow is flat, but they still generate a lot of free cash flow. Let's go through Buffett's annual letter. He just released this recently. Buffett always admits to his mistakes. That's a respectable CEO. Sometimes I've made mistakes in assessing the future economics of a business I've purchased. This happens with judgments about marketable equities. This includes partial ownership of a business and the 100% acquisition companies. From 2019 to 2023, I have used the word mistake or error 16 times in my letters to you. Other companies have never used either word over that span. Amazon, I should acknowledge, made some brutally candid observations in their 2021 letter. All other companies talk about happy things and provide positive pictures. That is true. Companies never say negative things. Even if something is negative, like they lost money, they always word it where it doesn't sound so bad. Buffett acts as the director for a lot of large public companies, and you can never use the word mistake or wrong. They're forbidden words at board meetings. At 94, it won't be long before Greg Abel replaces me. In 2024, they did better than expected, although a little more than half of their 189 operating businesses reported a decline in earnings. Our insurance business delivered a major increase in earnings, led by Geico. In 5 years, Todd Combs has reshaped Geico in a major way, increasing efficiency and bringing underwriting practices up to date. Geico was a long-held gem that needed major repolishing, and Todd worked hard in getting the job done. Their PNC business strengthened during 2024, reflecting a major increase in damage from convective storms. There was no monster event that occurred in 2024. Someday, a truly staggering insurance loss will occur, and there is no guarantee that there's only going to be one per year. Late in 2024, they had operating earnings of $47.4 billion in 2024. Our measure excludes capital gains or losses on the stocks and bonds we own. Those mark-to-market losses can really sway the earnings. So it's probably better to strip that out. When I say mark-to-market, those are the unrealized gains or losses on their stock. So if your stock goes up $100,000 in a year, you don't actually have $100,000. If you sell the stock and realize the gain, then you do. Same thing with a loss. If you lose $100,000 in a year, you didn't lose any money until you sell the stock. But holding companies have to report mark-to-market gains and losses on their income statement. That's why there's these huge fluctuations. Here's a breakdown of the operating earnings. It grew a lot from $37 billion to $47 billion. Their biggest is insurance investment income, $13.7 billion. Then other controlled businesses, like Apple, $13 billion. Non-controlled businesses, $1.5 billion. That's when they hold between 20% and 50% of another company, Occidental and Berkshire. The $1.4 billion in other, that includes foreign currency exchange gains of $1.1 billion. Last year, we made 4 payments to the IRS totaling $27 billion. That's how much they paid in taxes last year. That's about 5% of what all corporate America paid. So they definitely paid their fair share. If they sent a check for $1 million every 20 minutes for the entire year, day and night, every 20 minutes, they sent $1 million check. After all that, they would still owe the federal government a significant sum. Let's look at their Japanese investments. They're growing their investments in Japan. It's been almost 6 years since they began purchasing shares in 5 Japanese companies. You're probably familiar with Mitsubishi, the banks Mitsui and Sumitomo. I'm not too familiar with these two. Let me know if you want to join me in Omaha on May 3rd. I never went to the meeting, but I would love to. They're going to open their doors on Friday from noon to 5 with Squishmallows, underwear from Fruit of the Loom, Brooks running shoes, and a host of other items to tempt you. I really want to go, and he doesn't have that many years left, so maybe we can meet up there. Let me know. Only 1 book for sale. Last year we featured Poor Charlie's Almanac and sold out 5,000 copies. This year we're going to offer 60 years of Berkshire Hathaway. He started the company 60 years ago. That's a long tenure. Greg and Ajit will join me in answering questions. Ajit runs his insurance arm, which is the biggest part of his business. Here's my favorite part, the percent gains or losses. His first year, his portfolio went up 50%, S&P 500 10%. Second year, this is really good too. It went down 3%. The reason it's good is because the market went down 12%. You can never look at a number in a silo. You have to compare it to a benchmark. 67 wasn't that good. It went up 13%, but the market went up 30%. So in 1966, he had a good year and lost 3%. In 1967, he had a bad year and gained 13%. In 1968, he crushed it, up 78%, while the market only 11%. 69, 19%, the market went down. 1970 was bad. He went down, the market went up. 80% in 71. 72, he didn't beat the market. Yikes, 74. That was a big crash. He went down almost 50%. 1976, 129%, and the market only 24%. Unreal. Again 100%, 1979. 94% in 85. The market only 31%. Wow, look at these numbers. 59%, 84%, a 23% loss. In 1994, I interned at Credit Suisse First Boston, and I always looked at his stock because it was the most expensive. I think it was $13,000 when I was looking at it, and I thought to myself, who would pay so much for one share of stock? I really wish I put my bar mitzvah money into his stock. I would have had millions today. Because my bar mitzvah was in 89, I probably could have got a couple of shares. Instead, I gambled it away on football. Well, not all of it, but I lost about $5,000. I did make some back in baseball. There were two pitchers that were crushing it that year, Tim Wakefield and Hideo Nomo. They just kept winning, so I was betting on them a lot whenever they pitched. 95, up 57%, the market 38%. Wow, 1999, he lost 20%. The market was up 21%. Because he wasn't betting on the dot-com companies, so the market did really well. He didn't. And then people said, he's getting old, he doesn't know what he's doing anymore. You have to invest in these internet companies. But look what happened the next few years. He gained 27%, the market went down 9%. He gained 6%, the market went down 12%. And the market went down 22% in 2002. He lost 32% in the Great Recession, which is better than the market 37%. And I bought one A share in 2017. He matched the market. He did better than the market in 2018. I was happy with my investment. In 2019, up 11%, the market 31%. So he was not beating the S&P 500. 2020, same thing. He was not beating the S&P 500. And I was getting annoyed. I was like, why did I invest in this stock? 2021, pretty equal to the market. Then it started coming back. He was outperforming the market by the end of 2022 because he did up 4%. The market went down 18%. So I think my Berkshire stock is up maybe 170, 180%. And my S&P 500 is up about 150%. Because in 2017, I sold all my stocks and then I bought a bunch of stocks and pretty much kept my investments since 2017. I remember buying Meta and I was playing with options. My Meta stock got called away because the stock went up too much. I was doing covered calls. Since 1964, his annualized return is 20%, the market 10%. So for 60 years, the market went up 39,000%. He went up 5.5 million%. Let's look at a stock on Simply Wall Street. Its last price, $479, 1 trillion market cap, flat in the past week, up 15% in the past year. We'll look at the B shares. If you own 1,500 B shares, that's equivalent to 1 A share. Here's the A shares. 1 share of stock is $718,750. Not the highest market cap. There are 3 companies more than triple the size: Apple, Nvidia, and Microsoft. Buffett introduced the B shares in 1996 to make the shares more affordable, and they started out at $20. And the reason his shares are so expensive is because he never split. Also, he never pays a dividend, but the main reason is because he never split. If Apple never split or Microsoft never split, each share would be several $100,000. So from 1996 to 2008, it went from 20 to 90. Then it came down to 46. I bought the stock in 2017, and then by 2020, it was up like 50% or something like that. Then at the COVID bottom, I was down on my investment. And a lot of people would sell. When a stock goes down, that's when people sell. And when the stock goes up, that's when people buy. You should really do the opposite of that. But since the COVID bottom, the stock has really ran up. It keeps breaking its all-time high. A lot of people are talking about all the cash the company has, $320 billion of cash. I think that's the most of any company. He is expecting a market downturn. I mean, he's not all cash. He owns a lot of equity, but he definitely has his fair share. He did sell a lot of his Apple stock, which is really building his cash pile. They did repurchase $70 billion of their own stock from 2020 to 2024. They only bought back $5 billion in 2018, 2019. But $70 billion over 5 years is $14 billion a year. Any company can use the word float, but it's usually used for insurance companies. Float is the money held by an insurance company that has not paid out claims yet. That money belongs to the policyholder, but the insurance company is holding it for now. A lot of banks make a majority of their money on float. That's the interest they receive on the float, on the cash. For example, a company like PayPal receives a lot of money from people buying products. So they may hold the money overnight or maybe just for a few hours. So you buy something with PayPal. So you give PayPal money. PayPal then gives your money to the vendor you bought a product or service from. So lots of banks or credit card companies make their money on float. Even if they hold the cash for just one day, that could be billions and billions of dollars of cash. Even getting a really low interest rate, like a 1% annualized interest rate, it could really add up when you have so much cash on hand. In the past, their cash tracked their float. Now, cash has taken off well past the float. The nice thing about sitting on cash is you can act really fast when buying a company. Think of it buying a house. Say there was a house that was for sale for $250,000. If you came in with all cash at $250,000, say somebody else came in at $260,000, but they needed a bank loan. The homeowner may sell to you because it's guaranteed they're going to get paid. When someone needs to take out a loan, there's a chance the bank doesn't supply the person credit, so they can't get that loan. And this company is no longer undervalued. They used to be, but now they appear overvalued. They mentioned that also on Seeking Alpha. Will Berkshire pay a dividend? It's very unlikely, because if they have extra cash to spend, they'll buy back stock instead of a dividend. Seeking Alpha says, I don't expect this to happen. Berkshire's policy is no dividend. If Warren Buffett passes, we may see a dividend. Simply Wall Street thinks the stock is undervalued. Their valuation is $877. That's interesting. No analyst price for this stock. In 2014, they had $73 billion of debt, and that seems to go up each year. Now it's $124 billion. A lot lower than their equity. Equity, $600 billion. And we know that cash is high, $325 billion. A year ago, on 3/30, their cash was $188 billion. Buffett's annual salary is $100,000. Total compensation, $400,000. Tenure as CEO, 55 years. 58% of the company is owned by institutions, 27% by general public, and 15% by insiders. Buffett is the biggest shareholder at 14%. He's worth $148 billion. Vanguard, 7%, then BlackRock. Norges Bank, 1%. Schwab, 0.5%. And Dimensional Fund, 1/3 of 1%. Their employee count went from 316,000 to 396,000. On the holding company level, there's only a few employees, maybe like 5 or 6. Buffett, Greg Abel. But all these employees are in their operating businesses. The ticker trades on the New York Stock Exchange, Deutsche Börse, Wiener Börse, London Stock Exchange, Mexican Bolsa, Zitra, Bern, Lima Bolsa, Bulgaria, BATS Europe, Colombia Bolsa, Santiago, Buenos Aires, and the Toronto Stock Exchange. So if you want a copy of my discounted cash flow model, click on the video in the top right corner.